Welcome to Tech Money Madness, your daily U.S. stock market deep dive. Today is August 14th, 2026, and looking at the latest daily market briefing you shared with us, the financial landscape today is just this massive web of contradictions.
Yeah, it really is. I mean, on one hand, you have the domestic housing market facing its worst conditions in 3 years, U.S. warships maneuvering around naval blockades, and the broader S&P 500 sliding downward.
Right.
But then, on the other hand, you ask yourself why 5 million people just rushed out to buy a Pokemon game.
Yeah, it sounds like a punchline, honestly.
Mm.
But that's exactly our mission for this deep dive today. We're going to use this briefing to cut through the noise of a really mixed market day and extract the vital signals for you, the listener.
Absolutely, because we have a mountain of data here. We're talking about everything from a trillion-dollar AI arms race to shifting geopolitical supply chains to massive legacy tech companies just, well, losing 80% of their value.
It's wild. So we're going to map out how all these isolated data points actually connect to form the reality of your portfolio and your daily life.
To do that properly, I think we have to start with the top-down perspective, right? Before we look at individual companies, we need to understand the macroeconomic pressure cooker.
Okay, let's unpack this. Because the S&P 500 ended lower today, and investors are weighing all this mixed data.
Yeah, and, broad retail sales completely missed expectations.
Right. But the most vital signal in the briefing isn't the S&P dropping or the retail miss. It's the movement of the 10-year Treasury yield, which is just steadily inching higher. Think of the economy like an engine, and that rising 10-year yield is the temperature gauge blinking red.
If we connect this to the bigger picture, the reason it's blinking red makes total sense. We have a geopolitical stalemate in the Middle East right now that is making investors very nervous.
Yeah, the briefing outlines that the Trump administration is ratcheting up rhetorical pressure on Iran. And we just want to be clear, we're strictly reporting the facts provided in the briefing here, remaining completely impartial.
Exactly. And the facts show that while the military conflict is in a strategic stalemate, the economic tactics are escalating dramatically.
Right, the U.S. is enforcing a naval blockade of Iranian ports.
And at the same time, the Navy is actively working to relieve the USS Abraham Lincoln carrier group in the region.
So the bond market is looking at this blockade halfway around the world, and they're pricing in the risk. They're worried global shipping lanes will slow down, energy gets squeezed, and inflation goes up.
That's the exact mechanism, yeah. A blockade creates a supply shock, which creates inflation. So bond investors demand a higher yield today because they fear their money will buy less tomorrow.
Right, that rising gravity makes mortgages more expensive here at home. But it's also forcing a rewiring of the global supply chain, specifically in defense, right?
Oh, absolutely. The administration just ordered direct tariffs on foreign-made drone components.
And drone stocks rallied immediately on that news. But wait, I have a pushback question for you here.
Go ahead.
Is this drone tariff just a quick fix, a temporary political maneuver? Or does it signal a permanent rewiring of U.S. defense manufacturing? Because taxing foreign drone parts just makes everything more expensive for U.S. buyers in the short term.
Well, it's definitely signaling a permanent rewiring. The U.S. is actively looking to scale defense manufacturing to chip away at China's massive drone dominance.
Right.
By making foreign components artificially expensive, the government is guaranteeing a baseline of demand for American manufacturers. Investors see that and realize domestic companies don't have to compete purely on price against overseas factories anymore.
Ah, I see. So the era of cheap, optimized global supply chains is kind of fracturing.
Exactly. And moving manufacturing back to the U.S. is structurally more expensive in the short term, which is inflationary, which again keeps that 10-year yield marching upward.
Okay, so we see capital flooding into domestic defense, but the everyday consumer is pulling back. Retail sales miss the mark. But here's where it gets really interesting.
Yeah, the micro-reality is a huge contradiction.
Completely. Overall, retail is down. Yet Disney CEO Josh D'Amaro just reported that their theme parks were a, quote, big surprise last quarter. He specifically highlighted clarity and stability for the company.
And then you look at Nintendo.
Right. Nintendo was a top market gainer today. Shares popped 7% on the news that their new game, Pokemon Pokopia, topped 5 million in sales.
5 million copies in an environment where the average consumer is supposedly tapped out.
How do you reconcile that? People aren't buying generic retail goods, but they are shelling out for premium Disney tickets and $60 video games.
Well, in times of economic or geopolitical stress, consumers often cut back on broad retail goods, right? They skip buying a new car or upgrading the
They're
kitchen.
the big stuff.
Exactly. But they fiercely protect their spending on established, nostalgic entertainment.
Oh, wow.
It's an escape. If you can't afford a massive financial milestone like buying a house right now, you look for immediate psychological comfort. They are escaping the gloom. That makes so much sense. So consumers are escaping into virtual worlds and theme parks. But the corporate side of the economy, Wall Street, they are playing a much higher stakes game.
Oh, yeah. The mega cap tech companies are locked in a trillion-dollar AI arms race.
And the numbers in today's briefing are just mind-boggling. Amazon is projecting a massive $220 billion spend on AI and cloud infrastructure just in 2026.
And Amazon was one of the most active stocks today, by the way.
Right. Let me give you an analogy for that $220 billion. It's like a city deciding to build a massive 10-lane highway network entirely out of pocket before they even know exactly how many cars will drive on it.
That's spot on. And you know what's fascinating here is that Amazon remains the only $3 trillion company that has never paid a dividend.
Never.
Investors are essentially saying, keep the cash, build the data centers, we believe in the AI infrastructure, and the whole tech sector is functioning on this leveraged growth.
Yeah, Alphabet is another most active stock today, and they are well positioned to hit a $5 trillion market cap.
$5 trillion, let that sink in. Driven entirely by this AI-driven growth in cloud and data centers. Even Warren Buffett's Berkshire Hathaway is increasing exposure to tech, leaning heavily into Apple and Alphabet.
But there's a huge layer of market risk here that investors are taking on, especially regarding human capital. We're seeing major leadership shifts at the exact same time they're spending all this money.
Yeah, Apple CEO Tim Cook is officially stepping down.
Right, with John Turnus taking over on September 1st.
And it's not just Apple. Over at OpenAI, they're seeing significant C-suite turnover right now.
Which is raising huge concerns ahead of their planned IPO. You're pouring $250 billion into infrastructure, but the architects at the top are leaving. It creates a lot of instability.
So what does this all mean? If AI is pulling the market up, what is dragging it down? Are there foundational cracks you need to watch out for?
Well, let's look at the market movers section of the briefing. Uber is a top gainer today, up 5%.
Right. After partnering with China's Pony.ai for 2,000 robotaxis in Europe, the market loves them replacing human labor with AI.
Exactly. But then look at the losers. PayPal is a top loser today, down 5%.
And this is the crazy part. Their total payment volume actually grew by 10% year over year. But the stock is down a staggering 81% from its 2021 peak.
Right, because legacy digital payments are buckling under the pressure of narrative shifts. They aren't an exciting AI company anymore. They're viewed as a utility. Meta also dropped 3% today.
So the market is actively punishing anything that lacks an infinite AI growth narrative. But I have to push back on this AI optimism.
Go for it.
How can we reconcile a potential $5 trillion Alphabet valuation with the fact that the housing market is facing its worst conditions in at least 3 years? Mortgage rates are at their highest in over a year.
This raises an important question, and it really breaks down the dichotomy of the 2026 economy for the listener.
Yeah.
The market is heavily skewed right now. Tech and AI are soaring to historic valuations, while traditional economic pillars like housing and even legacy digital payments like PayPal are just buckling.
And there's an even darker warning sign in the briefing. Cybersecurity.
Right. Data breaches are surging in 2026.
Because AI is playing a growing role in generating and executing these cyber attacks. So the same tech we are pouring billions into is actively weaponizing the internet.
Exactly. We are centralizing our vulnerabilities. And, if you zoom out to the ultimate macroeconomic warning sign.
The Shiller-KP ratio.
Yes. The S&P 500's Shiller-KP ratio has reached levels we haven't seen since the dot-com bubble in the year 2000.
Wow. So the ratio between actual earnings and the price investors are willing to pay hasn't been stretched this tight in 26 years.
It's purely narrative momentum at this point. People are terrified of missing out on the AI boom, just like they were with the internet boom.
So to briefly recap the through line here for you today, we are navigating an economy where a geopolitical stalemate and a terrible housing downturn are basically being masked.
Masked by consumers escaping into Disney and Nintendo, and Wall Street funding a heavily leveraged trillion-dollar AI boom.
Exactly. Which leaves you with a final lingering question to think about today. We see corporations investing hundreds of billions to build the ultimate AI infrastructure to reach these multi-trillion-dollar valuations.
Right.
But with AI simultaneously fueling a massive surge in 2026 cyber attacks and data breaches, will the ultimate legacy of this tech boom be measured by unprecedented wealth or unprecedented vulnerability?
That is the multi-trillion-dollar question. Power without security is a very fragile foundation.
Something to keep in mind as you watch your portfolio. That's all for today's deep dive. Remember, staying curious is the best way to navigate the noise. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.